latest US GDP data is out and it paints a rather grim picture on the macro front. Well, the GDP estimates for the first quarter of 2024 has come in lower than estimated at 1.6% as opposed to what we were expecting, a 2.5% uptick. Well, the core PCE for the same time has risen to 3.7% at an annualized rate. The jobless claims have come in at 2.07 lakh, lower than the estimates. Well, on the back of this, we are seeing the 30-year Treasury hit its highest level since November 9 last year. To discuss this and other macro developments, I have with me Saugata Bhattacharya, who's joining us, with the independent economist joining us, and also David Benioff for Geoff Dennis, who's an independent emerging markets commentator, joining us. Gentlemen, welcome to ET Now. So good to have you on the show. Look at these numbers that have just come in. While we were expecting the GDP to moderate to around 2.4%, there is a sharp, downbeat coming on that front with GDP at 1.6% in the first quarter. What does this massive cut in the growth indicate? How are you reading into this?
Hi, Ankita, sorry. Is that for me?
Yes, go on.
Thank you very much for having me on your show. So obviously, this was a surprise, as you mentioned very articulately in the beginning, that markets were expecting a 2.5% growth, instead of which it's turned up at 1.6. So we are still not, and there are multiple other signs of slowing, because as you saw the flash PMI numbers for the month of April, those have come in lower than expected, significantly lower than expected, manufacturing and services. So there is no doubt that the economy is slowing. And a large part of the slowdown seems to have come in from the GDP numbers. Large part of the slowdown seems to have come in from consumer spending. Yeah, so even that has slowed down. It was expected at 3.5%. It's come in at 2.5%. So even that has slowed, as has other segments like exports, higher imports too. So, I mean, a significant slowdown in economic activity in the first quarter, which seems to be continuing into the second quarter as well. However, this still does not show any signs of a hard landing, that is to say either recession or close to zero. It's still fairly respectable. Remember that the IMF had increased its forecast of 2024 US growth earlier from 2.1 to 2.7%. So, I mean, it's still relatively strong. And as the employment numbers seem to be suggesting, that the labor market still remain tight. On top of which, on the other side, exactly as you mentioned, the Fed's preferred measure of inflation, the personal consumption expenditure, particularly the core, non-food, non-fuel, has come in at 3.7, which is a very, very sharp uptick. This was projected to be somewhere around 2.5%, this number. So the Fed is in a real dilemma, real quandary about how to go about, how to move forward with rates, etc. As you've seen, market, the 10-year, the 30-year bond yield, the 10-year bond yields have gone up sharply. The dollar has gone up sharply. And markets seem to be suggesting that if at all, there will be one or at the most two rate cuts. Even that is very, very unlikely in 2024.
Right, coming to you, Mr. Dennis, along with the downbeat growth rate for the quarter, the report showed consumer prices increased at a 3.4% pace, well above the previous quarter, 1.8% advance. This has raised concern over the persistent inflation and also put question, whether the Federal Reserve will be able to cut rates anytime soon.
Well, I've got two problems with the market reaction to the report. First of all, this is history. It's Q1. Q1's over. And your other commentator rightly points out the more relevant data point, I think, recently has been the PMI, which is showing some signs of slowdown. The second point is we know inflation was high in the first quarter. It typically is seasonally high in the first quarter. And we got that, okay, higher than expected, but still high is what you get in Q1. And that's what we've had with the CPI. It may suggest that the March PCE number, which we get, I think, at the end of this week, could be a negative surprise, sure. But this is all history. And if the market really is worried about a slowdown in the US economy, why are yields going up? This is a reaction to the inflation data. And I think there's every sign with especially with the soft start to April, that the inflation numbers will be much better in the second quarter. And that's the reason why I'm sticking to my forecast of 2 rate cuts in 2024, one in July, well before the election, one in December after the election. So I think the market is getting this wrong, frankly. I understand why the equity market is down, because this is a sort of stagflationary number. You know, GDP lower than expected, inflation a little higher than expected, but this is all history. And that should not be a surprise on the inflation side. Note also that there were big drags on the GDP numbers from net exports, as your commentator argued, and also from inventories. The domestic demand, I don't have the number, will have been stronger than the 1.6%. So the market's getting, I think, a little panicky about these numbers. My view is inflation will soften in Q2, and you'll get a reverse of what you've got now. The growth numbers may be a little higher, the inflation numbers will be lower in Q2, and that will probably lead the way to rate cuts in the second half of the year.
Saugata, do you concur with this, that it's going to be reversed in the second half of this year and we will see rate cuts soon as well?
So difficult. I mean, my colleague, my colleague on your show, obviously knows the U.S. economy much better than I do. But my sense is inflation might slow, although the problem seems to be, as many of the Fed speakers are emphasizing now, that the disinflation process seems to have stalled. The other factor is, given the strength, not just in the labor market, in employment, but also in the housing market, so which contributes a lot to the services inflation. And we know that services inflation tend to be usually much more sticky than goods inflation. I'm a little doubtful. My guess is, I agree with him that growth numbers are likely to improve in Q2. But I'm not very sure how far inflation is likely to come down. I agree with him that inflation is probably likely to be lower than what we have seen in Q1. But my sense is not too much, and certainly not anywhere close to the Fed target of 2%. That's the worry in all of this. But growth is slowing, but not significantly enough. The components of growth, both in the housing markets, housing segment, which is what has propped up the growth number to whatever 1.6. And given the still tight labor markets, not very sure how much inflation will slow further from now on.
Right. Okay. So a slight bit of a conflicting viewpoint coming in there from both the guests. But Mr. Dennis, tell us, the lackluster GDP has added further pressure to an already a tense market contending with concerns over a pullback in growth among technology earnings. For how long is the uncertainty likely to persist in the market?
Well, you need some more data points, obviously, I think, to turn the market around, and clearly the weakness that we're getting today was going to happen anyway prior to the release of the GDP report, because of the poor earnings released by Meta, which had pulled down the Nasdaq futures prior to the GDP report. I think the earnings story generally across the U.S. market will remain reasonably robust. Of course, the market is definitely richly priced. I don't deny that at all. I think the point I'm trying to make is that we have got 3 CPI releases before the July FOMC meeting. And while I don't think the March PC logically will give us a positive surprise, a lower than expected number, because you've got all this sort of, it's all baked in the cake to a certain extent, and Q1 was strong. I just happen to believe that there is a bit of evidence, sorry to repeat, there's a little bit of evidence at the margin that whatever happens to GDP, which is always historic anyway, there is a bit of early evidence from the April data, the PMI specifically, that you are going to see a bit of a slowdown. And if that happens, you will see, I think, a bit of a pullback in inflation. Now, my colleague on this show is absolutely right that the inflation numbers have flattened out. They're not going down anymore at the moment, but they're not going to accelerate on trend. And I think there is enough there still, potential, as the economy shows some signs of softness, the consumer perhaps looking a little tired here. The housing market, okay, may contribute to GDP, but on the other hand, Mortgage rates are at a new multi-year high, and that's going to pull back activity again. I think there's going to be enough pullback in activity generally in Q2, not to raise the risk of recession particularly, but to be enough to help to bring service sector inflation and other parts of the inflation down enough that I think there will be scope for a kind of what you would say, a precautionary rate cut by the Fed in July. Bear in mind a point that I've made many times in material I've written and also spoken on media, is that the Fed doesn't want to be forced into raising interest rates cutting interest rates for the first time in September, because that'll be just before the election, and the Republicans will argue that that's going to benefit the Democrats. Why wait until then? Similarly, the Fed doesn't want to cut rates for the first time in November, which is just after the election itself, because then they'll be criticized for the Democrats for not waiting. For waiting that long. So I think they'll cut in July and then in December. That's a cautious move. And I think the macro data, both the growth and the inflation, ought to be consistent with that by the time we get there. But I grant the point. We've got to get there yet, and the inflation numbers do have to soften, and that's something still that's uncertain.
Right. All right, gentlemen, Mr. Bhattacharya, Mr. Dennis, thank you so much for joining us and weighing in on that situation. Thank you so much for joining us. But
if you like this video, then like, share and subscribe to ET Now.